Before diving into the investment strategy, I'd like to give you just the overview of who we are and then what we do. Avenue Living is essentially a alternative asset manager established in 2006 with a focus in real estate. So obviously not all real estate is created equal, but what we like to focus on is what we call investing in the everyday products that people interact with on a daily basis. So this includes residential apartment housing that people live in or rent from. Those include self-storage units that we use and also Canadian farmland. We are now a 7.4 billion in terms of total asset under management. So it's been truly a remarkable achievement since we started the firm about 19 to 20 years ago. Another piece I wanted to talk about is just that we're not just a asset manager, but also we do all of our operations. So that means we handle everything in-house from acquisitions and leasing to property management. This vertically integrated model really allows us to be able to maintain control over the entire investment cycle. So if you're looking at the map on the left, you will see we have a presence in every Canadian province and a few US states. So really making us a well-diversified firm across North America. And on the bottom, which I think is very important to highlight with today's uncertainty, is just how long we've been operating. Just as any business, as we've been through a lot of up and downs. Specifically, we've operated through the global financial crisis. We've been through the commodity crisis around 2015, 2014. We also saw a COVID-19 and what that did with the market. We lived through the tightening cycle as well. But what has proven to be true is that we've always been that steady growth product that is defensive. And through all those periods, we've never had a negative annual return. We've never run into redemption issues. And all monthly redemptions or monthly distributions have been paid 100% and on time. And I think part of our success was really attributed to a couple of things. One, we focus on being an operation first company, meaning that we have boots on the ground on every single asset we own. But also another key factor is just that we have a very focused and dedicated investment strategy, which I'm going to touch on in a bit. So in terms of leadership, given the time we have today, I wouldn't go into the details of everyone's bio, but I do wanted to highlight that apart from their deep expertise in real estate operations and finances, the management team right now still have about 207 million that's invested in Avenue Living strategy. So they are shoulder to shoulder with our investor community, which really shows alignment of interest. Myself as well, I would say this is a wrong example, but 90% of my own financial wealth is also invested with Avenue. So we truly believe the strategy that we work on, and also that has to be very successful. Obviously, I wanted to give a little bit time to talk about our core trust strategy, which is really the flagship fund that's been with us. Currently, the fund is about 5.2 billion asset under management. That represents about 500 or 551 properties or buildings that are very diversified across North America. So what it really means is that because we have 500 of them, so not a single property or a region actually represents a significant portion of our portfolio, which really adds a unique diversifier. And what it means is that within that 500 buildings, it represents about 19,444 units. And that's split about 15% between our Canadian provinces and into the US markets. So earlier I talked about how we maintain defensive even during the challenging economic downturns, but that was really attributed to our investment strategy. So what is our investment strategy? It is what we call workforce housing. So workforcing, what I mean by that is workforcing refers to the residential units that are tailored to middle income earners, the people making $20 to $50 per hour. Think about people that you come across working at places like Costco or Tim Hortons. They form call it the backbone of the Canadian economy. These individuals often are overqualified for their government subsidized housing, but also cannot afford to buy their first home in major urban markets right now. So as a result, they represent a very sticky tenant base. They actually represent for about 30 to 40% of Canadian population. And then because of that reason, we like to buy properties or actually invest in the properties that tailor to those demographics. So if you look at the photos I kind of presented here, is that our workforce housing properties are not like the luxury development you often see downtown Toronto or Vancouver. They are very typically like modest walk-ups or older legacy assets, but they do offer affordable, functional, and safe housing solutions to our tenants. And in order to serve those demographics, we typically look at what we call affordability metrics. And the CMHC, which is Canadian Mortgage Housing and the Corporation, defines that affordability really means if someone were to spend less than 30% of their household income towards housing, whether that is to do with mortgage or rents. In our market, that means if someone were to make $100 per month, they should spend less than $30 on rents. And then obviously to meet that number, it is nearly impossible to achieve in places like Toronto or Vancouver. That's why earlier, if you see our demographics or geographic allocation, it was especially within core trusts is that we really focus on the market like Alberta, Saskatchewan, Manitoba, is that we really like to maintain that affordability construct within our tenant base. And what really does is being able to providing our tenants with affordable, safe, institutional quality accommodation, but also I think it's very important to highlight today is that to our investor, it also provide a very safe downside protection. What I mean by that is that if you really can think about in tough times when people start losing jobs, it is easier for people to downgrade from a luxury building to more affordable housing than the other way around. So occupancy tend to stay relatively steady during economic downturns at those properties. At the same time, those properties would also offer some upside potential. So if you're thinking about when markets start to boom, rent increases can be actually captured more quickly because you're starting from a lower rent base. I can give you an example. If you're talking about 10% rent increases on a $1,000 base rent, is about $100 per month, right? 10% on 1,000. But if you're talking about 10% rent increases on a $300 base rent, that rent increase is actually $300. So it's not the same magnitude. So in addition, we would talk about Alberta, Saskatchewan market. Not only it does have a lower rent base that gives us a lot more upside potential, but there's no rent control, meaning that allows us to be able to have a better and quicker reactions to the market demands. And this is something I wanted to show you here is really, if you truly look at the current market rental landscape, is that the lighter blue areas are really where Avenue Living has been focused on compared to the rest of the urban centers in Canada, such as Toronto and also Vancouver. What you really quickly realize is that there's still a very big, call it affordability gap compared to two different markets, right? If you're talking about Toronto, Vancouver, the average rent is about $3,000 to call it $3,400 per month. If you're talking about the lighter blue area, which is really we focus on in Calgary, Edmonton, the average rent is about $1,700 to $2,000 per month. So you're looking at least call it $1,000 to $1,500 per month of rent gap. So this really reinforced that our thesis in those kind of mid-market Canadian regions continue to really offer a downside protection and also additional upside opportunity. And then that's essentially something that has happened, I think, over the past couple of years is we are a Calgary-based company. We've seen a record high of night migration coming to places like Alberta. This chart really highlights the last 2 years. We've seen an average of 43,000 new residents coming to the province per quarter. That's about 300% higher than the past 5-year average. And what's interesting about this migration that's actually more interprovincial migration, meaning that people coming to Alberta are actually moving from places like Ontario or BC. And then the main driver of those call it big migration it was actually by the search for affordability. People are priced out of places like Ontario and they are looking for something more affordable. That's why they may move into the center of Canada. And one thing I think I wanted to highlight is that essentially this time when it comes to migration or when it comes to a population influx wasn't really necessarily to do with oil and gas. It was really driven by what we called flight to affordability. And because of that reason, if you truly look at what we're going to acquire in the future, is essentially we continue going to be focusing on the areas that we've seen a very strong strength, and then that's in places like Alberta, Saskatchewan, but also a little bit into the States. But if you're looking at our acquisition in the States, they actually exhibit the very similar attribute as what we are seeing in places like Alberta. When it comes to buying new buildings or future acquisitions in the States, we never wanted to look at places like New York City or Miami or California. We like to look at the states, places that just have very steady population base and also meeting that, call it affordability metrics. And then obviously with that, I wanted to touch base on the fund performance. Generally, I don't want to lead with performance, but I think performance is something really showcase that strategy has proven to be resilient, defensive, but also worked. If you're looking at the fund performance, we've never had a negative month. We delivered a 9.11% annualized return since inception. In year of 2024, we delivered a 13% return. But I think one thing about short term, but also I wanted to talk about long term because I think our investment communities are here with us for the long term. If you're looking at the past 5 years trailing average, we achieved over a 10.56% annualized return. I think return is one thing, but also within the return, we target 8 to 12% total return, and we've been hitting that every single year. Within that 8 to 12% return, about 5% of that return is coming from distributions, what we call distribution yield. So that is payable to our investors on a monthly basis. But also another portion of that 8 to 12% return is from capital appreciation. So it's combined with both cash yield and also capital appreciation as a whole total represent about 8 to 12% of the total annualized return. And then obviously, I think it's important to highlight in today's market is that how we are compare ourselves against, call it a general public market. I think a lot of investors coming to us was not just chasing for that return. Return is one thing, but I think long-term stability is actually another very important thing to consider. So this chart really highlights how we are compare ourselves against three different, I would say, indexes. One being the public equity market, one is public fixed income market, one is a public REITs market, which essentially our business doing the exact same thing, but they're traded on the public market. As you can see here is that when everyone's going up, when market's going up, everyone's going up on the public side. When everyone's coming down, everyone's coming down. So it does have a very close correlation if you're public traded security, whereas as something like Avenue Living, we are traded privately. So it is a private investment that has a very low correlation with public traded securities. So you as an investor got different investment that make you money, right? So what you want is that when one segment is not doing as well, you got other segment can get you better returns to offset the risk. So that's what we call risk diversification, is that you don't want to put all your money into one basket. You do want to diversify. And then that's why is a lot of family offices are coming to Avenue Living today. It's not just only because of returns, it's about that stability over the long term. So how to get involved? It goes without saying that we are a private offering, so you do need to be a accredited investor or eligible investor to be able to invest. And please speak to your Raintree advisors about that. We do offer investment through registered accounts. That's why whether it's RSP, TFSA, RESB, and etc. Our minimum is 5,000. And then we do offer a USD denominated class, meaning you can use your US dollar towards your investment. As far as distribution yield goes, currently is about 4.94%, so call it 5%. That's payable on a monthly basis. However, if you if you want to reinvest that distribution, you do get a 2%, call it a DRIP program, 2% discount on purchasing NAV. And when it comes to redemptions, again, I've highlighted a few times, we've never had redemption issues. All redemptions has been paid full and on time. And for our Raintree network, you can redeem the fund within the first 3 years, but there's gonna be a penalty on the declining schedule. After 3 years, there's no redemption fees, and you can redeem on a monthly basis. With that, I think that summarized my today's presentation. And if you have additional questions, feel free to reach out to your Raintree advisors.